right, let's get right into it. Today, we're going to tackle one of the most polarizing stocks on the entire planet, Tesla. Is this company the future of AI and transportation, or is it just a house of cards, maybe on the brink of collapse? We're going to cut through all the noise, really dig into the numbers, and give you a definitive take on whether Tesla is a buy, sell, or hold right now.
So first, let's just frame this whole discussion with one absolutely staggering number, $1.5 trillion. That is the kind of market cap we're dealing with here. You know, a valuation that massive, it demands some serious scrutiny because it's pricing in nothing less than a world-changing future.
And that right there brings us to the central conflict of our analysis. Is Tesla truly on the verge of dominating artificial intelligence and robotics, which would justify that massive price tag? Or is it, at its heart, an automaker that's facing some really fierce competition and a very, very real slowdown in its main business? This is the question we have to answer. To get to that answer, we're going to follow a pretty clear roadmap. We'll start by looking at the pressures on its car business, and then we'll decode its financial health using the numbers that actually matter. After that, we are going to tackle that valuation debate head on. And finally, we'll deliver our verdict and even explore some alternatives in the EV space.
Okay, so let's dive into this first section. Before we can even start talking about robotaxis and AI, we have to understand the state of Tesla's primary business today, which is selling cars. And right now, well, that business is showing some pretty serious cracks.
Now, what's really telling here is the trend this chart reveals. See, Tesla's once dominant position in the global EV market, it's eroding. The company's market share has dropped from 20% all the way down to just 13% in about a year and a half. This isn't just a number on a chart. It's a direct threat to Tesla's ability to set prices and its brand as the undisputed leader.
And here is the biggest reason why. Meet BYD. They are the new global market leader in electric vehicles. While Tesla's lineup, the Model 3 and Y, is starting to feel a bit dated, BYD has used its incredible vertical integration. And that means it controls its entire supply chain, from the batteries to the finished cars, to offer a much wider range of models and captures 16% of the market. The competition is not coming, it's here, and it's winning. So on top of the competition, Tesla's facing what I'd call a trifecta of major risks. First, the entire tech premium built into that stock price. That's all the extra value investors give it for being an innovator, not just a car company. It all depends on them delivering full self-driving. Any failure there would be absolutely catastrophic for the stock. Second, you have geopolitical tensions forcing a really complex and costly split from its China supply chain. And third, these ongoing legal battles over executive pay have put their corporate governance right under a microscope.
Okay, now let's see how all these business pressures are actually showing up in the financials. The story the market is telling and the story the numbers are telling, well, they feel like two very different things right now. We really need to decode what these key metrics are telling us about the health of the business itself. First up, revenue growth. And this is a major red flag for a company that's valued on growth. Analysts are actually expecting revenue to shrink by over 20% in the fourth quarter of 2025 compared to the year before. For a stock trading at such a high multiple, a decline like that, it's a really serious concern. To put that in simple terms, it's kind of like a super popular store suddenly seeing its holiday sales just fall off a cliff. It makes you start to wonder if its best days are already in the past. Next up is profit margin, which tells us how much money Tesla is making on each car it sells. And, well, that number has been shrinking. After peaking at over 29%, it's now fallen to around 18%. The squeeze on their margins is a direct result of more competition and those price cuts they've been making. Think about it, like a coffee shop that's forced to drop its prices because a new cafe opened up next door, all while the cost of coffee beans is going up. It's just making less and less profit on every single cup it sells. That's exactly the kind of pressure Tesla is feeling. But it's not all bad news, not at all. The company's balance sheet is incredibly strong. With a debt-to-equity ratio of just 0.07, Tesla has very, very little debt compared to its size. And this is a massive financial advantage. It gives them the stability to get through downturns and to find all those ambitious projects. It's literally like having a tiny mortgage on a giant mansion. And that leads us right to free cash flow. This is the real, actual cash the business generates after all the bills and investments are paid.
This is the lifeblood that funds everything from new gigafactories to R&D and robotics. And Tesla's ability to generate this cash is a core pillar of the bull case because it lets the company fund its own massive ambitions without going into debt. So, with that financial picture now in our heads, we get to the real heart of the debate, the valuation. This is where we have to confront that huge disconnect between Tesla's current performance as a car company and its sky-high stock price. Can that price tag possibly be justified? Well, some fundamental analyses are brutally clear. According to one base case intrinsic value model, the stock is overvalued by a staggering 88%. Now, this view basically suggests that if you strip away all the futuristic hype, the underlying financials of the car business simply cannot support the price today. And this perfectly captures the two competing realities here. The bear case sees an overvalued car company with slowing sales. The bull case sees a future AI and energy powerhouse. The bears say, hey, value it on today's car sales. The bulls say, no, you have to value it on tomorrow's robotaxi and software revenues. These aren't just different opinions. They're fundamentally different ways of defining what Tesla even is as a company. And you can see this division perfectly reflected in Wall Street's price targets. Just look at this spread. It's absolutely incredible. The low forecast sees a 96% downside, basically a total collapse. The high forecast sees a 32% upside. When the pros are this divided, it signals profound uncertainty. So how on earth is a regular investor supposed to make a decision? Okay, we've reviewed the business, we've gone through the financials, and we've laid out the valuation debate. Now it's time to put it all together, synthesize all this data, and arrive at a final verdict for anyone looking at Tesla right now. Based on a consensus of Wall Street analysts, our recommendation is a hold with a 12-month price target of $379.08 per share. So here's the thinking. The risks in the core auto business are just too big to ignore, which makes it a really risky buy. But the potential of their AI and robotics ambitions is so massive that selling now could mean missing out on a truly world-changing technology. It's a high-stakes waiting game. So the whole thing really boils down to this one powerful tension. The bull case rests entirely on Tesla's potential to win the race for autonomy with its low-cost, vision-based approach. But the biggest risk, the huge risk, is that if they fail to deliver on that promise, the stock will be revalued as just a car company, and a struggling one at that, which would be absolutely devastating for the share price. Now, for investors who find that risk-reward profile just too volatile, there are some pretty compelling alternatives out there. You could look at BYD, the current market leader that's executing brilliantly and trading at a much more reasonable price. Or for a more defensive play, you have legacy automakers like Ford and GM. They offer a sort of slow and steady way to invest in the EV transition without the same level of existential risk that's baked into Tesla stock. And that leaves us with one final question for you to think about. Tesla has very clearly pivoted to an all-or-nothing bet on AI. But given the very real slowdown we are seeing in its main business, is the market really appreciating how much is at stake if that AI future doesn't materialize exactly as they've planned? And that is our deep dive on Tesla. Let us know down in the comments what company you want us to break down next. Thanks for watching.